In 2021, the two biggest things on everybody's mind were inflation and the housing market. And now here we are in 2022, and the two big things on everybody's mind again are inflation and the housing market and the midterm elections. But on the financial side, it's inflation and the housing market. Just take a look. The Mortgage Bankers Association says that home prices are going to drop by late 2022. But then you have other experts say that interest rates are going to rise, and as they do, prices should come down. But the big X factor is the supply, because we still have a low inventory of homes. And then you also have inflation hitting the housing market. And so you have some sellers saying, no, I want more money for my home because of inflation, which brings us to the question that everyone's asking. Will the real estate market crash in 2022? Let's start by talking about interest rates, because in 2021, we saw 7% inflation. And so now the Federal Reserve Bank feels that they need to raise interest rates quickly. That's why they've said time and time again that they're going to be hiking interest rates in 2022 as a way to combat inflation. And that means if interest rates go up, houses are going to become more expensive. Here we have a picture of, well, a home. I always like it when people call me the Bob Ross of finance. If you don't know who Bob Ross is, well, I feel bad for you. So here we have a picture of a home, and home affordability is determined by two different things. It's determined by home prices, ES, and then it's also determined by interest rates. These two things determine the home affordability, because not only do you have to look at what the home costs, but you have to look at what is the mortgage going to cost you. So if we take a look at this home, let's assume that this home costs $500,000. If you bought this home with a 30-year fixed rate mortgage, I'm just going to assume for the purposes of this video that you're putting $0 down. So you're getting a $500,000 mortgage, and you were doing a 30-year fixed rate mortgage. And you can get this mortgage for, say, 2.8%. These were the type of interest rates that people were getting on their homes in 2021. Well, that means this home is going to cost you right around $2,000 a month to purchase this home. Well, if interest rates go up to just 5%, which really isn't that high in the grand scheme of things, because we saw interest rates almost at 20% in the early 1980s. So we're just gonna say 5%. Well, now your home is not gonna cost you $2,000 a month. It's gonna cost you almost $2,700 a month, only because interest rates went up. Now, all of a sudden, this home is going to cost you a whole lot more, not because the home is more expensive, but because interest rates went up. I'm going to erase the whiteboard right now, but I want you to remember this. As interest rates go up, your monthly payments start to really rise. The reason why interest rates are so important in the housing market is because interest rates play such a big factor into home affordability, and interest rates are going to be determined by none other than the Federal Reserve Bank. So you have to understand how all these different pieces play together. So if we start by looking at wages, in 2021, we saw one of the fastest growth in salaries in history. We saw wages grow by right around 4% a year. At the same time, we saw home prices in 2021 grow by right around 19% a year. Again, one of the highest home price growths in 12 months ever. So starting here, we saw wages grow by around 4%. If you look at that by itself, that looks good. But if you compare that to home prices, where home prices grow by almost 20%, now it doesn't look so good. So to put that in perspective, we have home prices that are growing, I'll put this on the chart, home prices that are growing like this, while wages are not keeping up. So what does that mean? Well, relative to people's incomes, home prices are growing way faster, meaning it is harder and harder for people to go out and afford a home because the cost of a home has been going up so fast. Now, that isn't very sustainable. I mean, if home prices are significantly growing faster than wages for a long period of time, eventually you're gonna hit a point where people just can't afford homes. We started to see that happen in 2021, where buyers were starting to walk away because they just couldn't afford homes. Now, home prices and home affordability was subsidized in 2020 and 2021 thanks to the help of low interest rates. So yeah, home prices were going up, but we also saw historically very, very low interest rates. Some of the lowest mortgage rates that we have ever seen in the history of time. People were getting mortgages for under 3% a year. Some people were even taking out adjustable rate mortgages. That way they could take out a loan and pay less than 2% a year for the first 5 years. Now, I do not recommend you taking out an adjustable rate mortgage, especially when interest rates are at rock bottom, but this is what some people were doing. We were seeing the lowest mortgage rates in history, which helped contribute to these higher home prices because people said, hey, yeah, home prices are higher, but I can get a cheaper mortgage, so I'm willing to borrow more dollars right now because I don't have to pay that much money on my dollars. So then you have these rising home prices along with the rising prices of everything else, contributing to an inflation rate of 7% in 2021, which the news says is the highest inflation rate since the early 1980s. Now, the reason why this number is important to understand is because the way that the Federal Reserve Bank fights inflation is by raising interest rates. When inflation is high, they work to raise interest rates to cool down the economy. And the reason why interest rates are important, because that's going to affect this. So you have to understand how these factors play together, and the way that you can understand this is by understanding what the Fed is going to do to fight this. So here we are with inflation at 7% in 2021, and if you wanted to go out and get a mortgage, you can still get a mortgage very easily for 4% or less. I mean, you can usually get a mortgage for significantly under 4% right now, but let's just say 4% to keep it conservative. So you can go out and get a mortgage at 4% while inflation was at 7% in 2021. The reason why this is significant is because the media keeps talking about how this inflation number is the highest since we saw back in 1982. Well, in 1982, if you wanted to go out and get a mortgage, it wasn't going to cost you 4%. You were paying 16 to 17% a year on your mortgage because the Fed had to raise interest rates to fight the high inflation that they were seeing in 1982. Now, of course, this was after an era of stagflation in the 1970s, but what do you think that we're seeing right now? We are seeing slow economic growth, and we're also seeing high inflation. That is what the definition of stagflation is. So unless we can get inflation rates under control, we could be seeing much higher interest rates because that is how the Fed fights inflation. Right now, the Fed says that they want to raise interest rates a few times in 2022 and a few more times in 2023. Their goal is to bring interest rates up from 0, where we are right now, up to around 2% at the end of 2023. What that tells me is either A, the Fed doesn't think that inflation is a big deal yet, or B, the Fed thinks that inflation is a big deal, but they don't want to panic or spook investors by saying they're going to raise interest rates very quickly, because when you have inflation this high, and you're not really raising interest rates that much. I mean, yeah, we're going to see 3 or 4 interest rates hike in 2022, maybe another 3 or 4 interest rates hike in 2023. But relative to the amount of inflation that we're seeing, if inflation does not slow down, well, then that might force the Federal Reserve Bank to make a drastic U-turn maybe in late 2022 if they say, all right, we thought it was supply chain issues, we thought it was all these other issues, but inflation is not going away. If that happens, then they might be forced to raise interest rates significantly faster. And if that happens, well, then you could see mortgage rates bump up a lot higher too, which would make home prices significantly more expensive. And by the way, for all you money nerds that were wondering, the 7% inflation rate is CPI. CPI stands for Consumer Price Index. It looks at 8 different factors to see how people are seeing inflation in their regular lives. But this inflation number that we're seeing today, the CPI number, isn't the same CPI that they were using back in 1982. Because now this CPI, 25% of it, so let me just draw this out. So here are all the data points in the CPI, and just about 25% of it is housing costs, but they don't actually look at house prices when they calculate the CPI. They look at something called owner's equivalent rent, OER. And what owner's equivalent rent is they go around asking a bunch of homeowners, surveying them, asking them, if you were to rent your home out, how much would you rent your home out for? And no homeowner really knows what their home should rent for or what it would, so they just give whatever number that they think, and that's how they come up with owner equivalent rent, Why do they do that? Because it's a way for the government and these agencies to massage the CPI numbers to make it not look as bad as it is. Because in 2021, the owner's equivalent rent number, which is supposed to give us the idea of housing costs, was something around 3 or 4%. Meaning that in the CPI number, 25% of it is supposed to be our housing costs and home prices. And they're saying that home prices only went up by under 5% in 2021, when in actuality, home prices had gone up so much more. Why do they do that? Because that makes the inflation numbers look less than they actually are. And that in turn gives the Federal Reserve Bank and the government more leeway in terms of what they want to do. But in 1982, when they were looking at inflation and they were ramping up mortgage rates to fight inflation, they didn't use owner's equivalent rent. They actually used home prices when they were measuring inflation. So the inflation that we're seeing right now isn't actually 7%. The real inflation that people are facing is a lot higher than that. But thanks to the massage numbers, it doesn't look as bad. So now, in terms of practicality, what does all this mean and what should you be doing? Well, there's two separate things. First is on the side of interest rates, and second is on the side of home prices and what might be coming. First, in terms of interest rates, if you're thinking about buying a home and you want to take advantage of these low interest rates, you should do that while you still can, because we are going to see interest rates go up in 2022, and we're going to continue to see interest rates go up in 2023. And if later in 2022, the Federal Reserve Bank says inflation is not slowing down fast enough, they might start ramping up interest rates even higher. So chances are 12 months from now, we are going to see higher mortgage rates, maybe even significantly higher mortgage rates than what we're seeing now. And chances are in 24 months, we're going to see significantly higher mortgage rates than what we're seeing right now. In addition, if you own a home and you're thinking about refinancing, this is the time to do it, because we're going to see interest rates go up. You already own your home. If you wanted to refinance, that way you can have lower monthly payments, that way you can pay off your debt sooner, whatever it is, well, this is the time to do it, because you don't want to continue waiting, because if you keep waiting, well, then you're going to have to pay higher interest rates on your refinance, because interest rates are going to go up in 2022 and 2023. I'm going to get to the home prices in just a second, but before we do, if you are in the market for a new home or in the market for a refinance, make sure you shop around, because some lenders are going to charge you a whole lot less in interest and a whole lot less in fees for the exact same loan. And nowadays, thanks to the internet, it's not as hard as it used to be to shop around, because you can just use a mortgage comparison website. And the following is an advertisement from our sponsor Credible, who operates a mortgage comparison website. At Credible, you can check pre-qualified mortgage and refinance rates at no charge to you. They have multiple lenders competing on their marketplace. That way you can compare great rates and pick the option that's best for you. The process is super simple. All you have to do is go onto Credible's website and enter in a few pieces of information, which just takes a few minutes, and then Credible will present you with actual pre-qualified rates from different lenders. That way you can compare. Their pre-qualification process is easy to use. It only takes a few minutes, and checking pre-qualified rates does not affect your credit score. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I'll put the link to where you can do that with our sponsor Credible in the description below. Credible does pay minority mindset and advertising fee when you submit a pre-qualification request, and Credible Operations Inc. NMLS number 1681276 is not available in all states. So if you want to learn more and see what mortgage or refinance rates you might qualify for, I'll put the link to where you can do that with our sponsor Credible in the description below. Now, if you're in the market for buying a home, do not try to time the market. Nobody knows what the heck is going to end up happening to the housing market in the next 6 months or the next 12 months or the next 18 months. We know that interest rates are going to go up, but we really don't know what that's going to mean per se in the housing market in general. We know that rising interest rates mean the home prices would go down, but we don't know how fast the Fed is going to actually raise interest rates. And we also don't know what government programs the government might enact to change the housing market. Like, nobody would have thought that we were going to see a mortgage moratorium back in 2020 or an eviction moratorium. And so it's hard to predict what is going to happen because of those things. So you don't want to try to time the market. So if you are in the market for a home, the most important thing that you should be looking at is making sure that you can buy a home that you can afford. That means you can afford the down payment, and that means you can comfortably afford the monthly payments. And then you want to lock in a fixed rate mortgage. This is not the time to be doing adjustable rate mortgages, because if you take on an adjustable rate mortgage, well, I can pretty much guarantee that your mortgage payments are going to go up when it's time for your variable interest rate mortgage to adjust and to recalculate. So now for everybody else, the question then becomes, what is going to happen in the housing market? And you have to look at two things, supply and demand. Demand is how many people want to buy a home. Supply is how many homes are available for sale. So in 2020 and 2021, the issue that we were facing on the supply side is we saw a very low inventory of homes, while we also saw a massive demand of people wanting to buy a home. We had everybody wanting to move into the suburbs because they were working from home, and everybody wanted to take advantage of these cheap mortgage rates. So this created a massive amount of demand while the supply was so low. So you had everybody fighting for a small inventory of homes. Now, the demand is starting to cool down a little bit. People are still looking for homes. People still want to take advantage of these low interest rates. I mean, mortgage rates are still historically very, 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 very low. So you have people that want to take advantage of these mortgage rates. People are still looking to upsize. There are people looking to downsize. People are looking to move into the suburbs. So people are still looking for homes. You have a big demand for homes. It's just not as hot as it was before, but the supply of homes is still low. It is still hard for construction companies to build more homes because we are still fighting this labor shortage, which is kind of strange because unemployment has come down significantly. We have unemployment at under 4%, yet we're still facing this labor shortage. We're in this labor shortage where you have a lot of people that want more money, or you have people that are not willing to work these traditional jobs. They're doing a lot of freelancing work. And so the whole work environment has changed. And we're trying to figure out, and companies are trying to figure out how to cope with that. And so construction companies are still struggling to find labor to build homes, and now they're having to pay more money for their workers, which is causing the price of homes to go up because it's costing them more money on the labor side and also the material side. We saw the whole supply chain shortages and the supply chain issues happen in 2020 and 2021. Well, we're still paying the price for that. Some of these issues have gotten better, but they're still around. I mean, the cost of the materials to build a home are still way higher now than they were 12 or 18 months ago. And because of that, the cost of building a home is higher. It takes longer to build a home, and this is also keeping the home inventory low. So until we can start building more homes, until it becomes a little bit more affordable to build homes, if and when that ever happens, well, then it's going to be harder to see a home price correction because you still have this demand for people to buy homes. And in terms of a housing market crash, a big difference between now and 2008 is when 2008 happened, there was no equity in homes. Like, if you lost your job and you couldn't make the payments on your home, well, home prices were going down. And now you were underwater on a home that you couldn't make the payments on. And the reason why you're underwater and you cannot make the payments is because you were taking out an adjustable rate mortgage. So your payments are so much higher, and you're underwater, so you can't sell and you can't refinance. So you have these payments. You were originally paying $500 a month. Now it's costing you $1,500 a month because your mortgage payments readjusted. So you went from $500 a month to $1,500 a month, and you bought your home for $200,000, and now it's worth $150,000. Well, now you're in trouble because you can't make the payments, you can't refinance, and you can't sell. We're not seeing any of that right now because right now we're in an environment where, let's assume that you lose your job, you can't make your payments. Well, your payments are not changing because most people, thankfully, most people are not taking on adjustable rate mortgages. We are seeing a growth of adjustable rate mortgages, and we might see that grow more rapidly as interest rates go up. But right now, most people do not have an adjustable rate mortgage. They have locked in a fixed rate mortgage. So your payments are not changing. And even if now you cannot afford to make the payments because you lost your job, you can sell for a profit. Pretty much across the country, everybody has built in equity in their homes because home prices have gone up so much. Those are the numbers that I showed you just a little bit ago. Home prices went up by almost 20% in 2021. So if you bought a home for, say, $300,000 a year ago or 2 years ago, and now you, for whatever reason, can't make your payments, well, now you can just sell your home for a profit and walk away with $40,000 in your pocket, even though you lost your job and you can't make your payments. So it's a very different environment now than we saw before the 2008 crash. And so you have to factor those things in. Yes, we have real issues, real concerns, and real risks in the housing market, which could cause a correction in the housing market if we see interest rates start to really go up. And there is a good chance we could see interest rates really go up. But the likelihood of a crash, well, for that to happen, we will really need to see home prices go down to the point where people are underwater. And then we would need to see people that are no longer able to make the payments on their homes. So not only would you need to see home prices go down, but then you would also need to see people not being able to pay their mortgages. And we're not seeing the same adjustable rate mortgages that we saw before. So What does this mean? We don't have the same factors as we saw before 2008, but we have different risk factors, and the bigger risk factors now are not just in the real estate market, they're in the economy, and they're in inflation, because these are inflation numbers that we haven't seen since the 1980s. What's up, everybody? If you want to continue building your financial education, I linked a relevant video here that I think you'll love, and as an added bonus, I have a free guide on how you can start generating passive income that you can download and read for free. All you gotta do is click that button below.
Do I think that these tokens are going to succeed? No. I mean, I think that Bitcoin